I want to thank Hassan and Professor Athanasakos and Lyndon and everyone who's welcomed me here. It's really a privilege and a pleasure to be here. I've heard so much about the school, and I admire what Professor Athanasakos is doing with all of you, and I think it's a great opportunity for all of you to learn about value investing, which is something I'm really passionate about and really enjoy. What I wanted to do, I just have my computer at the end real quickly. I just want to show you two presentations I gave for Manual of Ideas. One was on United Health back in January of 2013 when it was $52. It's $170 now. And the other is Zoetis, which was back in the summer of July of 14 when it was $29 and it's $55 now. I did a 133-page PowerPoint on Zoetis and then a little one on United Health. It's about 60 or 65 slides. But that's why I have that up. I don't want to go over those, and I hate PowerPoints. So what I wanted to do is just kind of share some of my thoughts about investing to give you an understanding of what we look for and what we think about when we're looking at industries and companies within an industry. And I also want to, Hassan mentioned that I had the privilege of doing work through Mr. Buffett. I was really fortunate being with Bill Ruane and Rick Kniff and Bob Goldfarb and Carly Kniff. The projects I did for Mr. Buffett all came through Bill Ruane. And so Bill assigned me the projects and we just sent the research directly to Omaha. So I really wish I could have been right by his side working with him, but they were given through Mr. Buffett, but they were really done through Bill Ruane. I wanted to start by talking about investment principles and what you really need when you really start looking at companies or industries. You need a sound intellectual framework to kind of give you a grounding and a value system of what you're looking at. And some simple ones, the first is, in 1993, if you read the 1993 Berkshire Hathaway Annual, it's the greatest description I ever read about the 5 things you're looking for when you want to buy a business, whether public or private. And in Warren's and Mr. Buffett's way of thinking, the first 3 start with the certainty with which. And the first one, and I really use this every time I look at something, the first one is the certainty with which the long-term economic characteristics of the business can be evaluated. So if I look at, or our team, if we look at a business and I look out 2 or 3 or 4 or 5 years, and I don't have a good idea of where that business will be, I just get rid of it. I don't even look at it any further. I'm done. I can't project the cash flows. I can't value it. If I can't value it, I can't buy it. So if we don't have a reasonable idea where that business will be many years from now, and again, I don't mean predicting the future, but can the business economics really change quickly, et cetera? If they can, I'm just not interested. I'm not going to invest our client's capital in that. So that's the first one. The second one is really evaluating management as operators and capital allocators. And what you'll find is most management teams, there's very few CEOs, presidents that are good at both. And you can tell if they're good operators by what the numbers have shown you over the years. Part of that's dictated by industry structure and industry dynamics. But if they're earning 30% operating margins and everyone else in the same industry is at 10, that tells you there's something unique there, and they're obviously very good operators. Capital allocation is a separate issue. It's much more difficult to find management teams that are really good at both. And capital allocation is really important. Because if they're really a good operator and they're generating a lot of free cash, the question becomes, what do you do with that free cash? Dividend policies, stock buybacks, acquisitions, pay down debt, etc. There's really 4 or 5 things you can really do with that free cash flow. And how they allocate that cash flow really dictates a lot of the future success of the company. And a great example is Jill Barad was at Mattel in 1982 and really built the Barbie brand, $1.8 billion, $2 billion. It was a $4.5 billion company back in 99. And she saw that kids were growing out of toys quicker. So they bought the Learning Company, which was an $800 million business, and she paid 4 times revenues for it. So she paid $3.5, $3.6 billion for it. When Bob Eckert took over a few years later, he sold it for $1. So she was a really great operator and took the Barbie franchise to almost a couple billion in global revenue. But when she became CEO and was responsible also for capital allocation, she wiped out, and her team wiped out $3.5 billion in value by making an acquisition that they really didn't understand. So those are both really important points. The third is evaluating management as shareholder-oriented. You can really learn a lot by reading the proxy. I read every proxy. How do they pay themselves? What do they have in terms of stock options? What are the stock options available as a percentage of the shares outstanding? Restricted stock units, all the ways they're compensated really tell you a lot about management. Are they sharing the rewards with shareholders or pocketing a lot of it themselves? It's a huge point. The fourth is the valuation of the business, which is really critical. How do you value it? What's the value of the business? What's it selling for? And then finally, the general level of inflation and taxes during that time. Those 5 things that are in the 93 Berkshire Annual, I think are the finest description of what you're looking to sort through. If you can answer these questions and really have a good answer to these questions, you're going to do very, very well with your investments. Then I've studied Mr. Buffett since I was pretty young, read The Intelligent Investor 12, 13, and I followed him much more closely as I got into my 20s and 30s, and as I became hopefully more knowledgeable. But I've studied maybe 20 or 30 great investors. I read everything I can get my hands on. I'm kind of pathetic. I have no hobbies. So who here golfs? That's great. I've never golfed in my life. I think you guys are a lot smarter than me. You don't want to be like me. I don't have any real hobbies other than all I really care about is my family and our business, our employees and our clients. But my point is, at the end of the day, I've studied a lot of money managers out there to get a sense of how they built their businesses, what their focus was, how do they make investment decisions, how do they do research, etc. And so I put together a list of comments that I think would be helpful. The first is, it sounds simple, but a lot of people really don't follow it. I really want to understand the business. Simplify, simplify. I always want to make sure I can understand the business. Now, there's some investors, a lot smarter than I am, that love complexity. I have found that complexity causes problems. The more complicated things are, the harder it is for me to make money. There's more opportunity to make mistakes. More things can go wrong. If I can't really understand, there's thousands of companies out there, I just don't bother with it. So simplicity and understanding the business is really important. We like businesses with favorable long-term prospects. So I was telling some of the students earlier, you take Amazon. I mean, Bezos is just a genius. And again, I was so stupid. I never bought any. But the point is, they do about 150, 160 billion in revenue. Well, their runway in the US is probably 4 or 5 trillion. And maybe if there's other markets he'll get into, who knows how big it'll be. The advertising business that Google and Facebook are focused on globally is really probably 800, 900 billion. So Bezos has a much, much more favorable long-term runway. And long-term runways really, really matter. Because your ability, even if you have a successful model, if that model isn't replicable and doesn't have a long runway, you're not going to make a lot of money. So the long runway really, really matters. Third, you want it operated by people that are honest and capable. And working for Bill Ruane, one of the first things that jumped out at me, the moment he thought someone was dishonest, he didn't care if he still thought he could make money. His feeling was, when things are good, you'll be okay. But when difficult circumstances come about, you're really going to be in a lot of trouble with this individual who's not honest. And so how honest are they and how capable are they? It's really important. We want a very attractive price. And then another thing that's really, really significant in how we look at things, we try to get rid of all the noise and all the nonsense. At the end of the day, even if you spend 6 months studying a company, you do the financial analysis on the company, on all its competitors, you know the industry structure, you know the size of the industry, you do all this field-based interviewing. At the end of the day, everything always comes down to a handful or less of critical issues. Everything. So we try to focus on what's knowable and important. It's really important. And one of the things that really good investors, including Mr. Buffett, can do, they can really look at something and size it up quickly and identify the 1 or 2 or 3 key elements that really matter. So what's knowable and important? Albert Einstein once said, it's not everything that can be counted counts, and not everything that counts can be counted. It's exactly right. We look at we're absolute return oriented versus relative return oriented. I mean, absolute return, I love when you're tied to a benchmark and all this benchmark nonsense. Benchmark has value within reason. On the other hand, you don't want to be tied to it, because the fact that a benchmark was down 40% and you're down 38, you beat the benchmark. But your clients are down 30, they lost 38% of their money. So we try to remain absolute return focused. We seek long-term capital to avoid short-term pressures. One of the things I decided to do, and our team decided to do, is we decided against product. Money management's all about creating and selling product. Whether it's a hedge fund charging 2 and 20, and we agree with Mr. Buffett, there's some great ones out there. The great majority don't earn it. I think those are very egregious fees. Very few really earn it. Some do, and I admire and respect them, but most don't. We decided not to go the hedge fund route or the mutual fund route. They're highly distribution driven and they're marketing driven. So what we do is we have separate accounts. And so every portfolio is customized. And there's not a model. Everyone's different. Someone might be 40% equity, someone might be 55, someone might be 90. And what we do is we buy the same stocks in each one, but what's different is the allocation. So Wells Fargo might be 4% in somebody's account with 40% in stock. It might be 12% in somebody who's 80% stock. But we do it individually. There's no model. It's based on knowing each individual client. And the beauty of a separate account is the client owns the individual securities. We're simply the conduit through which they own them. So unlike a mutual fund where you can't control any of your taxes, they own it. So if we've done well on something, which the market, we're in an 8th year of a bull market, if we want to donate something to a foundation, or they want to bequeath it to their grandchild, they just simply take the stock, get the tax benefit of it, and can donate it. There's a lot of advantages to a separate account. So you have enormous flexibility. I'm not market cap constrained. So like when money management consultants look at me, they don't know what the heck to do with me. I have market caps of $1 billion. I got Berkshire with $450 billion. I got companies in Europe. They don't know what to do. There's no way to categorize me. So I'm not market cap constrained and I'm not geography constrained. Most people that have product create limitations. We're small cap growth, or we're large cap growth, or we're large cap value, or we're a long short hedge fund focused in healthcare. We can do whatever we want. And that's really, the only limitation should be your ability to generate unique insights and exercise sound judgment and then have the courage to really do it. So we don't like artificial limitations, and I think products really do that. Separate accounts don't, and they're really what's best for our clients. It's simple. They get a monthly statement from our custodian, Schwab. They can see everything they own. They can go in through Schwab Alliance and see their account 24/7. They get every confirm by email. So we decided to do that. The second thing we decided to do was to offer fixed income. And the reason is not everyone should be in the equity markets. And the firms I was at before, because they were equity focused, didn't do fixed income. Well, thank God we did, because we got really lucky. We found these really unique fixed adjustable preferred stocks, and they're half my assets now. So over the last couple of years especially, as we've been selling portions of our stocks that have done well, we're buying these fixed adjustable preferreds and our clients are getting 5, 6, 7, 8% yields to the call. And they're laddered from 17 all the way to 24, 25. So those are two decisions we made, customized. And what drove all that, one of the reasons Mr. Buffett's 100,000 times smarter than me, but one of his advantages is, and I don't think people focus on this enough, he has quasi-permanent capital. The best capital is your own. The second best is long-tail reinsurance float, which is what Mr. Buffett has. So, you know, he insures for hurricanes, so he gets the premiums, and then he can invest that until he has to make a payout. If you're an auto insurance, it's short-tail reinsurance. You can't really do that. If you look at Progressive with $22 billion in revenue and a $22 billion investment portfolio, only 15% is in stocks. The reason is it has to be in fixed income so they can pay the claims. Well, Mr. Buffett has long-tail reinsurance, so he might have that premium coming in every year for 20 years before he has to pay anything out. He gets to invest that. He's got 90 billion plus of it now. So he doesn't have clients. So he can sit around and wait for weeks, months, and years. Mutual funds that are being run by people, and I won't mention any names, some great mutual fund money managers, they can't go above 5 or 6 or 7% cash with a financial planner or a fire desk. And so it's an enormous advantage what Mr. Buffett has. And so that's what I'm trying to do in our business. Rather than have a hedge fund where they're calling you every week, the money may have come from fund of funds and others, the fees are very high, they're calling you regularly to see what your performance is because of those high fees, and you get a very small sliver of a client's capital. So you might get 1/5 of 1% of a billionaire's portfolio. In our case, we fortunately have gotten a large percentage of a client's liquid assets. In many cases, we have 60, 70, 80, 90% of a client's liquid net worth. It might be in 3 accounts or 4 accounts, but it's an enormous responsibility. But that's what we want because we want to build a stable, high-quality pool of capital. We want a 30, 40, 50, 60-year relationship. We want to know the family. So when we meet with clients, we try and get to know them. I don't even talk about money for the first 20 minutes. I want to get to know them. What are their goals? What do they want to do? And then we ask them 3 questions. The pool of capital you want to give us, what's the primary purpose? Growth, income, well, I need monthly income. Well, I want it mostly in stock. It's going to my grandchild. I don't need any of it. I have plenty of income. So it varies. So that's the first question. The second question is, if they don't have on the stock portion of their portfolio, whether it's 30% or 50 or 60 or 80, which we decide together, if they don't have a 3 or preferably 5-year horizon, I tell them, don't give me the money. So you can tell what a brilliant marketer I am. And I mean that. If you're not going to commit the capital for a long period of time and you can't afford to do it, you shouldn't be investing in a long-term asset. So that'd be like buying a house for $200,000 and putting $150,000 down. Then 2 years later, you might need the money. It's the same thing. Now, people don't look at it that way, but that's how they should. So that's an important point. And then the third question is, they shouldn't exceed their risk tolerance emotionally or financially. And what I mean by that, there was a firm that had a $200 million client he inherited. And he had some great money managers managing his money. And every time the market would go up and down, he'd have like a nervous breakdown. Well, he shouldn't be in the market. Financially, you could argue he's okay, obviously with that kind of wealth, but emotionally, he wasn't configured to be in the market. Then there's other people, clients that come in, and they'll give you $800,000, and that's all the money they have. Or someone just retired, and they took their 401k and rolled it over into an IRA, and they walk into your office, and that's all they have. And their feeling is, I really want 60, 70, 80% in stock. And they trust you, and they have the emotional makeup to do it. And that's really, really important. So the right kind of clients is profound and one of the greatest competitive advantages. And I learned that just by looking at Mr. Buffett. He doesn't have to worry about redemptions. I had a friend who was running a $10 billion mutual fund. And during the 98, 99, 2000 crisis, he didn't buy tech stocks. And all the money came from middlemen, which is what drives the business now, as opposed to direct relationships, which is what we're trying to do. And so what happened was, because he wasn't buying tech stocks, he was getting 150 million in redemptions every week. And the assets went from 10 billion to 2 billion. And he was having a nervous breakdown because he wanted to buy stuff, but he had to sell stuff at cheap prices to meet the redemptions. So who your clients are is so, so important. And it takes longer to build and develop these longer-term relationships, but it's a better business. And it enables you to do things that other people can't. A great example was I was a lot smaller in 2005. And a gentleman gave me $3 million in 2005. He's the only client we ever had. He's very wealthy. The only client we ever had who wanted all stock, as opposed to a balanced account. And he said, I don't want any fixed income. Well, we got it December 23rd of 05. 06 and 07 came. And I certainly didn't predict 08, 09. I'm not that smart. But what I knew in 06, 07 was all kinds of nonsense was going on. People were using in the US, they were using their homes as ATMs. Private equity buddies of mine were borrowing 98% of the money to do private equity deals. It was just insane. And I could go on and on and on. And so I wasn't comfortable. So I kept 50% of his portfolio or a little more for 2 years in cash. And I charged him the cash. Now, he wasn't getting zero back then. He was probably getting the fee. He was probably earning 1% on the cash or 1.1 in the Schwab Treasury account, whereas now you get nothing. And even today, I saw him in New York last weekend. He calls me even today, all these years later, the king of fixed income because he didn't want any. Now, because of his belief in me and our process, we now have 3 accounts from him, and you should see that original $3 million account. Because he allowed me the privilege of waiting, when the fall of 08 hit and the spring of 09 hit, we went to work and we filled the whole portfolio. And in fact, one of them was Mohawk, an idea I got from my late partners, Carly Kniff and Rick Kniff. And we paid 17, 18, 19, 20, 25, and we bought it, started buying it many years earlier, in the early 2000s. And then when the crisis hit, we went to 120. Then when the crisis hit, went back down to 17 barely, and then really went to 30, 35. Well, when he came on board, during the crisis, it got killed. We never sold any. We bought more. And just 2 weeks ago, we donated $1.2 million to his foundation. And I think he made 11 times his money or 10 times his money. We would not have been able to do that if he had made us invest in 06, 07. So it's really important who your clients are. Holding cash for its optionality. We hate leverage. We never invest borrowed money. Never. You're not rational. Bill Ruane taught me you're just not rational when you're investing money you don't have. You see things going down and you're losing money you don't even have. It's a disaster. So we hate leverage. We also hate it in companies, as well as investing. And then think about it. What's your edge as an investor? Analytical, informational, emotional, patience because of the client capital, which I talked about, which is one of the greatest edges. Berkshire and Buffett have the capacity. This is an incredible blessing that he's earned and built. He has the capital. They have the capital capacity to do almost nothing. Nothing. And the privilege or luxury to do nothing at all for years with no pressure. And he also has the luxury to do some of the biggest deals because of all the cash and the way he's under-levered. Investment flexibility. We can invest in any geography, any market cap, any industry, various asset classes, public and private. We're ferociously risk-averse. And John Templeton's great quote, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die in euphoria. It's a great quote. And then one of the things, it was really instructive for me. I've read every one of Mr. Buffett's letters from 1956 to 69, the Buffett partnership letters. And one of the great, most of the things you think about, he's already thought about it. So you think you're figuring stuff out, he's already thought about it. One of the interesting things is, when you think of Mr. Buffett, you all think about the quantitative and what a math genius he is. His mind is absolutely a math genius. But what's interesting is, in a 1967 letter to his clients, he said, everyone thinks of me as a quantitative person, a numbers person. He knows reinsurance, he's brilliant. But he said the great big ideas are his qualitative ideas. And I would second that. And here's some of the comments he made. The evaluation of securities and businesses for investment has always involved a mixture of qualitative and quantitative. And at one extreme, you've got the qualitative, buy the right company with the right prospects, good industry conditions management, and the price will take care of itself. The quantitative spokesman says, buy at the right price and the company and stock will take care of itself. So he vacillated between the two, but here's what's interesting. He said, although I consider myself to be primarily in the quantitative school, the really sensational ideas I've had have been heavily weighted toward the qualitative side, where I've had a high probability insight, and that's what causes the cash register to really sing. So the really big money tends to be made by investors who are right on qualitative decisions, but at least in my opinion, the more sure money tends to be made in the obvious quantitative decisions. So the reason I'm bringing this up is people think that investing is all about math and formulas. Bill never did any of that stuff. He did it in his head. He didn't sit down and create these 400-page sensitivity analysis models. He didn't do that. He just tried to understand the characteristics of the business. Were they sustainable? What was their unique competitive advantage that they could continue to replicate? Were they honest and capable? And then what are you going to pay for it? It's simple to think about, but very hard to execute, because you're buying things when no one else is. And I wanted to talk about how it's an art form, a broad range of quantitative and qualitative factors. And I wrote in my year-end letter last year, you're all familiar with the NFL, right? You have Canadian football up here, right? But you're all familiar with the NFL. Well, this is a great example. This gentleman was in the NFL Combine. He was one of the slowest quarterbacks ever timed in the 40-yard dash, 5.2 seconds. Very poor vertical jump. He lacks great physical stature and strength. He lacks mobility and the ability to avoid the rush. System-type player can get exposed and forced to ad-lib. Lacks a strong arm and doesn't throw a really tight spiral. Can't drive the ball downfield. Poor build, skinny, gets knocked down. So this analysis focuses on all the quantitative skills. How fast are you? How strong are you? But there's a broad range of characteristics that aren't really measured. Resiliency, desire, intellect, composure under pressure, ability to overcome obstacles. So this quarterback was the 199th player chosen in the 6th round in the 2000 NFL draft. 6 quarterbacks were chosen ahead of him. And as measured at the NFL Combine, in the 32 years of the NFL Combine until that time, 576 quarterbacks were evaluated. His scores were dead last at number 576. So on a quantitative basis, he was pathetic. The quarterback I'm describing is Tom Brady. And what's incredible, I know he came back and did this incredible job in the Super Bowl. When I wrote this, he played in 6 Super Bowls and won 4 of them. And the 2 that he lost, he could have won, plus some of the ones he won, he could have lost. They easily could have won the other 2, and they lost in 3 AFC championship games, where he may have played in 9 Super Bowls. But what's really interesting, if you studied his career, it's all there to see. He almost never got recruited for college. When he went to Michigan, he was 7th on the quarterback list. There was Drew Henson. He shared time with Drew Henson as a junior. They always put him in when they were losing. And I could go on and on and on. But because of the struggles and challenges he overcame, which is not measurable, he's ferocious. And whether you like him or not, my wife really likes him. She thinks he's adorable. But the point I'm making is, I'm using that as an example of what investing is like. It's not all quantitative, and that doesn't imply that if he could run the 40 and 4.4, he was bad. I'm just trying to point out that there's a lot of characteristics and qualities that you can't measure, but are visible if you go out in the field and do more research. And most people just don't do that. Investor qualities that I think are really important. It's a broad range. William Green did a great Google interview that you all ought to take a look at Google. And he talks about 3 qualities that an investor needs. It's a 59-minute presentation, and it's terrific. William Green. He also wrote The Great Minds of Investing. He's a really good guy, very smart. And one of the things he talks about, to be a good investor, the willingness to be lonely. It's really lonely. The power of humility, because you make mistakes, you have to control, you have to be humble, but not fearful. Because if you're not humble, you get your butt kicked. If you're fearful, you'll never make an investment. You also have to be confident, but not arrogant. Confident is you're basically saying, I'm right, or I wouldn't be making this investment. Nobody agrees with me. That's why it's cheap. But you don't want to be arrogant because you make mistakes. And so, willingness to be lonely, the power of humility, and the third one is the ability to really withstand pain. I mean, like in 08, 09, I mean, think about this. I'm using Mohawk as an example. Mohawk, we paid 17, 18, 19, 20, 25. It went to 120. And then when 08, 09 hit, it went to 17, very brief, and then really the third. Well, just think about that. This is people's money. This is people's retirement money. So you paid 20 for it. You made 6 times your money. So let's say it was 200,000. It was $1.2 million. And then a few months later, it was back to 200. We didn't budge. And I actually get excited at those times as long as the clients don't have a stroke. But the point is, we didn't sell anything. That's really what excites me. Like right now, it's really frustrating. I can't find anything to buy. Compelling. And we buy things that hold them for 5, 10, 15 years. And so those 3 characteristics, the willingness to be lonely, the power of humility, and the ability to take pain are really, if you don't have those, it's going to be very hard to be a really good investor. And he gives lots of examples. And I don't mean this in an arrogant way, because I always try to find smart friends of mine to blow holes in my ideas. But once we've done the work in our team, and I don't mean this, again, in an arrogant way, once we've done the work, I don't really care what anybody thinks. Because if I did, I'd never make a decision. And, I was a quarterback, nothing like Tom Brady. But I was a quarterback. It's great. It's a great position to play if you want to be a money manager. Because you're second guessed. There's Monday morning quarterbacking. You're the one holding the ball most of the time. You have to make decisions in 3 or 4 seconds that dictate the game. It's a great position. It can be a very lonely position. And it's a very painful position. And then other things are flexible, decisive, patient, focused. You have to be an independent thinker. I read people's 13 Fs all the time. It's a great source of ideas. But just because Mr. Buffett bought it, as much as I admire and respect him, that doesn't mean I should buy it. I have to understand it. Our team has to understand it. We have to understand it. Big picture and detail-oriented. We try to be really creative. We focus on process, not outcomes. Process you can control. Outcomes, in many cases, you can't. So we always try to make our process better. We do postmortems. Why did we screw up? What did we miss? Why did we miss it? What didn't we see? Open-minded, competitive. We're a risk manager. We're not a money manager. We're really a risk manager. And our broader vision is to make a meaningful difference in the financial lives of our clients. We don't look at ourselves as a money manager. We really want to help our families. Peter Thiel said to Mark Zuckerberg, in a world that's changing so quickly, the biggest risk you can take is not taking any risk. Something to think about. Munger, I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they're learning machines. They go to bed every night a little wiser than they were when they got up, and boy, does that help, particularly when you have a long run ahead of you, which he's had. Focus on what won't, and here's another really good thing. Focus on what won't change 5 and 10 years from now. Everyone always focuses on what may or will change. Think about what won't change. It's a great insight, because that's what you want to invest in. Change is great for the consumer. Change is terrifying for the investor. Good communicator, clarity and simplicity in ideas and communicating them. Aristotle, we are what we repeatedly do. I had to throw something Greek in there. We are what we repeatedly do. And I don't know if you all know, but I'm fluent in Greek, and my parents were Greek immigrants. So we are what we repeatedly do. Excellence, then, is not an act, but a habit. Ray Dalio, meaningful work, and from Bridgewater, whom you probably all know. Meaningful work and meaningful relationships through radical truth and radical transparency. Thoughtful disagreement creates the power of understanding. Thoughtful disagreement creates the beginning of understanding. Now, you all have probably read about Bridgewater. I have enormous respect for what Ray and his team have built at Bridgewater. I don't really know him, and I would never diminish, but the thought of every meeting being videoed. I don't know how keen I'd be on that kind of an environment, but that's what they do, and it's proven very successful there. But those are some important, I think, characteristics. And ultimately, as all of you build your careers and your lives, whatever your choices are in life, personally, professionally, the reality is the quality of your life is really going to be dictated by the quality of your relationships. I mean, just think about it. I mean, if you marry the wrong person, just think about that. I mean, I have friends that were walking down the aisle and knew they were making a mistake. No. Now, on the other hand, I got really lucky. I still don't know what the hell Kelly's doing with me 32 years later. But I just say thank God and I don't say anything. But the point I'm making is, think about it. The relationship, your clients, your colleagues. I mean, do you want to go into work every day and work with people who make your stomach churn? Life is really short. When I worked at a hospital for 8 years, drawing blood. It took me 8 years to graduate from college. I worked every weekend and holiday. And I would draw blood from people and do the tests on it. And every week, I would read the paper. I'd read the sports and the business, and I'd go into the obituaries. I saw people dying every week, which is very unusual. When you're 18 to 26, most 18 to 26-year-olds, and I wouldn't have either if I didn't have that job, they never think about that. Well, I saw it every day. And I lost a sister in 99 at age 42. And so life is really, really precious. And even more important than investing is the relationships you build throughout your life personally. Because when you're happy personally, it enables you to have a foundation to be happier professionally, and it feeds on itself the other way around. You just don't want to, there's just so many jerks out there. You just don't want to be around them. Life's just too short. Just eliminate them. You just eliminate them. I'm being very serious. I'm an old fart, so I can say this. Bill Ruane was a really special guy. A couple of the lessons I learned from him: never invest borrowed money. You don't act rationally. Invest in your 6 or 7 best ideas. I'm not smart enough to do that, so I do 10 or 15 normally. Never focus on the overall market, as no one knows what it'll do. I never think about the market. I think about overall valuations of the market, but I never think about the market today, tomorrow. I look for individual securities. Invest in a business, not a piece of paper. Do your own in-depth research and analysis. One good idea every other year is just fine. I've always thought of myself as a meek little lamb who's afraid of being fleeced. Integrity of management, which I talked about, is paramount. And one little side story that's really important. And you know, you hear about all these barracudas in the financial world space. Our second son was born in Greenwich, and he had an atrial septal defect, which is a hole in the upper chambers of his heart. It's in about 1 in 120 kids. And normally they wait till you're about 4 years old and they operate before you go to kindergarten. Well, his was moderate sized, so he wasn't thriving. So he had to have it at 10 months. And I worked in a hospital 10 years. And I think you can tell I don't really trust very easily. So I wouldn't let any pediatric open heart surgeon touch him unless Aldo Castaneda at Boston Children's trained him. So I started doing, and it wasn't like now. This is 1990. See, now you can find all this on Google. So I tried to get a list from Boston Children's Hospital, which is really the best in the world, about who some of the residents he had, so that he trained and where they were. And we found Bill Norwood at CHOP in Philadelphia, which is really the second best children's hospital. And being the paranoid schizophrenic I am, I went and interviewed. And he told me in 40 years he'd never been interviewed by a parent. So I'm asking, doctors aren't used to this. I'm asking him, well, how many procedures do you do? What are the risks? And he's looking at me, he said, Paul, I take apart whole hearts, I rebuild hearts, this is nothing. Well, it's not his kid. And so my point is, he got it done. And the reason I'm telling you this is when I went to interview at Ruane, I met Bob Goldfarb, who was very good to me, and Greg Alexander, who's a genius that no one knows, and Carly Kniff, who's brilliant. I met a bunch of the people there. And then I went back again, because I had a brief period with Carly, and I went and met Bill Ruane. And this will give you some insight. So I'm in Bill Ruane's office, and I'm trying to get a job. And he's sitting in his office, and he has the research that I did sitting on a desk. And he spent 90% of the conversation talking about our son. He loved the research I did. He thought that was great. And then at the end, he said, he looked at my work, he said, Paul, this is good work. I really like your work. And so then he says to me, he says, how much does an operation like that cost for Tyler? And I said, I don't know, Mr. Ruane, I don't know what it costs. He said, whatever it costs, I'll pay for it. So I looked at him and I said, but you haven't hired me yet. And he looked at me and he smiled and he said, I'm going to. And the reason I'm telling you this is, think about what kind of human being that is. And what's amazing is people say to me, well, he was wealthy, so he could do that. It has nothing to do with that. Certainly he could afford it. That's not the point. The point is he was a terrific human being. And that's the kind of people you want to be around, as opposed to people who would take a nickel from their mother. And I'm raising that because I want you to think more broadly than just investing. It's a very important point. Management qualities. Ben Horowitz made the comment at Andreessen Horowitz. They asked him about some of the great entrepreneurs. They have an unbelievable original view of the world. They're original thinkers. And then they have the courage to build a great company on that original view of the world. I mean, they are really out there. Not only do they think differently, they have the courage to follow through. I mean, look at Bezos. He was working at D.E. Shaw. He went to Princeton, got an engineering degree. Working at D.E. Shaw, the hedge fund, making a lot of money. Hops in his car. He saw in '94 the explosion of the internet. So he hops in his car, moves to Seattle with his wife, and starts Amazon. I mean, that's just not normal. He had a great job. And then the courage is the first virtue. Again, this is Aristotle. Courage is the first virtue, as without it, nothing else matters. It's rare to find the brilliance and courage in one individual. And why is courage important? Because let's say you think you have integrity, and your boss comes down and asks you to do something unethical. You know it's wrong. Do you really have the courage to say, I'm not doing that? And you can get fired. Courage is really, and it's really important in our business. It's really hard to develop the confidence and the courage. And at the end of the day, the difference between Brady and Buffett and the majority of others is a multitude of factors. It's a multifaceted issue. But one of the biggest is courage. And it's a really hard, it's undefinable. And you don't know if you have it until you have to experience very, very difficult times. Integrity, honesty is the foundation of any relationship, both business and professional. Be fanatical and love what they do. One of the gifts that Mr. Buffett has, most people that are really good quantitatively and with numbers, they don't have people skills. And I'm not putting them down, that's just their nature. And the opposite's also true. People that have very good people skills aren't very good with numbers. He's extraordinary in that, and very few people talk about this. He has rarely, in a career that spans 60 years, he's rarely made mistakes on people. It's astounding. It's astounding. And he doesn't get the credit he deserves for that. Founders, owners, managers, you want them to think alike. Teams and execution are the keys. Leadership is vision plus communication and judgment. Delegate and segregate duties, which leads to higher output and better quality. The current economic environment, just briefly, I wanted to say, the global financial markets and the global economies to which they're inextricably tied are operating in uncharted territory on a global scale. Global debt levels are frightening. Global debt levels are 320% of global GDP, which is $75 trillion. It's frightening. Government, look at the US government, $20 trillion deficit, $4 trillion budget. So we spend $4 trillion a year, we bring in 3.5. Of that 3.5 that we bring in, 75% is individual income taxes, which is about half of it. The other 25% is payroll taxes. Corporate tax is like 9% of $300 billion, not even relevant. The point I'm making is, on the spending part of the $4 trillion, and what are we doing about this? Nothing. $4 trillion, almost $1 trillion is Social Security, and $1 trillion is Medicare and Medicaid. And those two are $2 trillion of the $4 trillion that we're spending. There's 11,000 baby boomers in America turning 65 every day. So if you look at Medicare and Medicaid and Social Security 10 and 20 years from now, it's frightening. And what are we doing about it? I mean, it's just, the point I'm making is it's a scary time. Rates have been kept artificially low globally for a long time. It has all these unintended consequences. Now, do I ever make investment decisions on any of that? No, but I think about it. What does all this mean? It's frightening. Artificially low interest rates, I talked about global debt levels. Hyman-Minsky policies, which attempt to stabilize things in the short run, are ultimately destabilizing in the long run. An important point that'll serve you well all your life. One of the things I have noticed, I'm 56 now, so I'm an old fart. People that are really successful have the unique focus, commitment, and never give up attitude. Like I have friends that call me, they're an analyst, and many friends that they're making a lot of money, $500,000 or $1 million or $2 million, whatever the number is. And then they say, I'm thinking about doing my own thing. Then I say to them, that's great. I would encourage that. And then they say, and I figure if I don't get where I want in a couple of years, I can always go back. I can tell you right now, if that's how you think, you're never going to succeed. You have to dive in full tilt and give it everything you have to build your own business. I mean, read about Phil Knight. Read about Howard Schultz. I mean, I could go on and on and on. And those are successful ones. Phil Knight, if you read Shoe Dog, he almost lost his business 3 or 4 times if the bank didn't renew loans. Because he was buying Onitsuka Tigers over in Japan, and he couldn't get the bank to finance them. Calvin Coolidge said, this is a great quote, nothing in the world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with talent. Genius will not. Unrewarded genius is almost a proverb. Education will not. The world is full of educated derelicts. Persistence and determination alone are omnipotent. The slogan, press on, has solved and always will solve the problems of the human race. It's really important for all of you. You're going to encounter difficult times like we did with our son, Tyler. Those are devastating times. And obviously very important, but not as important as human life, although some clients probably think so. When the market got killed in 08, 09, those are really times when you find out how smart you really are. How tough are you? How capable are you? It's easy when you're a quarterback and you're winning 28-0. It's very difficult when you're like Brady and they were losing by 3-4 touchdowns in the Super Bowl. It's extraordinary that he came back. It's just unbelievable. That's a resilience that's so rare and so unique. And you're all going to need that in your life, whether it's in your personal relationships or professionally. Steve Jobs said, have any of you listened to his speech at Stanford? How many of you have? Well, it's on YouTube, and it's also, there's transcripts. It's one of the greatest speeches. He tells 3 stories from his life. It was from 05. I would urge all of you to listen to it again and again and again. Those are great, not just business, but even more importantly, life lessons. One of the things he says, I'm convinced that about half of what separates successful entrepreneurs from the non-successful ones is pure perseverance. Bezos, it's the basics, focusing upon selection, low prices, reliable, convenient, and fast delivery. And this is also really important. It's the cumulative effect of having this approach for 14 years. I always tell people, and this applies to our firm, and I'm not comparing us to Amazon, but I always tell people if we have a good quarter, if we have a good investing year, it's because of the work we did 3, 4, 5 years ago. It's not because we did a good job this quarter. So you plant seeds and you constantly develop knowledge and insights. And when the opportunity comes about, give me an example. Martin Marietta, I was introduced to it by Tom Russo. And Professor knows him. He's a great investor. The only negative is he's Italian. That's the only negative, but he's a great guy. He's a great guy and a great investor, great person. He introduced me to Martin Marietta. I get ideas from all over. I get ideas from all over the place. And he introduced me to it in 99, 2000, 2001. And I studied it for 10 years. And then in August of 11, so clear, in August of 11, over that period, it went from 180 to 60. And we made it a 5% position. It's 220, 230, 240 today. And there's an example. So at the end of the day, it's just so important to be patient, to think things through, and when the opportunity presents itself, really jump in. Founders think differently. We love companies that are founders. When you start a company, he or she, it defines you. You look at it differently than being named the CEO of a company and spending 5 years there and trying to get as much as you can in stock options and make as much money as you can. We love founders. It's their life, a long-term focus. They're passionate, they're driven to solving problems. They're leaders with vision. They communicate and they have great judgment. Hiring great people that are honest, dedicated, passionate, strong work ethic. Buffett says integrity, intelligence, and intensity are work ethic. And he always focuses on those 3, integrity, intelligence, and work ethic. And if they don't have the first, he says, I hope they're dumb and lazy. But he's done a great job picking people. People and culture are the critical elements. Bezos said, if everything you do needs to work on a 3-year time horizon, then you're competing against many people. If you're willing to invest on a 7-year time horizon, you're competing against a fraction of those people, because very few companies are willing to do that. We've had 3 simple ideas at Amazon we have stuck with for 18 years. Put the customer first, invent, and be patient. Now think about that. If you had your money, if I was running a mutual fund, could I wait 10 years to buy Mark & Marietta? I had clients that allowed me that privilege. It's the only way to win. I mean, think about it. You go to an institution and they give you $100 million. And they say, okay, Paul, you can invest in small cap value. The consultants bring you in, you can invest in small cap value. Market cap has to be less than $5 billion. Here's $100 million. You have a week to invest. Now, how are you going to beat the market doing that? Now, if it's March of 09, you can. If it's October of 08, you can. But how are you going to beat the market? You need a time frame that you can find things to buy. And great opportunities don't come around that often. Mike Moritz from Sequoia Capital takes a tremendously long time to build a company of value. People would be staggered the length of time we hold investments. It's not uncommon for us partners at Sequoia Capital to hold stock for 15 or 20 years. You guys know who Sequoia Capital is? The venture capital firm? Google, Facebook, Amazon, they were in all those. Mike Moritz, a lot of really, really talented people. Don Valentine's really the quasi-founder along with Cap Research. Most people don't know Cap Research helped start that. There's a lot of really smart people there. Jim Getz. In choosing a money manager, if all of you are looking for a money manager, or your parents are, I've identified what I think are 5 things you should focus on. First is impeccable integrity. 2, I'd ask about the research process. You know, Paul, how did you find United Health? Why did you invest in it? How did you research it? Almost no one asks that. A third caveat that I would use, and there are exceptions, there's a lot of great people out there, but my preference is to invest with management teams and investment firms that are owned by the principals. Now, why do I say that? Because when you're at a big firm, especially a big firm that's publicly owned, there's all these people you have to answer to. So let's say you're a wealth manager at one of these big firms. You have a boss. Why didn't you raise more money? Why didn't you sell that product? And then he answers to someone above him. And then the CEO answers to the stockholders, which are concerned with quarterly earnings. You're far better off finding an investment firm where the firm is owned by the principals. And that's really important. So at our firm, we're not 2 billion or 20 billion, but at our firm, we only do what we think is best for the client, period. That's it. Whatever's best for the client. I don't have to answer to anybody but my client. And finally, the firm's owned by the principals. How invest your money? My money's in a partnership. We buy everything our clients buy after our clients buy it. So that's where all my liquid net worth is. It's nowhere else. It's right there. And then finally, everyone asks about performance and fees.
So when you started investing for your clients, probably at a young age, how did you build a track record to sort of gain the trust of your clients? Because you talk a lot about gaining trust of your clients as doing the right things, and sometimes that means waiting for a long time with the money or keeping 50% off equities and in cash. So how do you convince people at first that you're capable of doing this and that they should trust you with that money?
That's a great, great question. When people talk about starting a business, the most difficult, there's several components. Do you want to deal with employees? Do you want to deal with insurance? Do you want to deal with networks and cybersecurity? Do you want to deal with compliance? Do you want to deal with the SEC? All those are important. Another important one is, do you really have the confidence to take people's money and invest it? People are investing their IRAs and their life savings with you. Do you really have the confidence to pull the trigger and do a good job for them? But probably the most difficult early on is the one you're addressing. And that is, where's the pool of capital going to come from? And so for me, the way it worked was, it took 16 years to get to where I am. Part of that's my fault. I have no third parties. I control every relationship. And I think it'll be a better business in the long run. And what it came down to, it's people who knew me and trusted me and just believed in me. So I'm not comparing myself by any means, but when Phil Knight started Nike, Jeff Bezos' parents gave him a couple $100,000, which was virtually all their life savings. And he even told them they could lose the probability is 70, 80% they're going to lose all of it. They just believed in him. And so that's what it comes down to. Now, after we've been around and we built that track record, it's gotten easier because now I have a 16-year track record. And so I can show people that now. But it was really, really hard in the beginning. That's a great question. Really hard. Ultimately, the answer is they just have to make a bet on you. Period. Because that's all you've got. You don't have a track record.
What's your biggest investment regret?
Boy, that's my biggest investment regret would be several companies, and I was telling the students earlier how dumb I am. I went to the Gabelli Automotive Aftermarket Conference. This is just one. My biggest regrets are mistakes of omission. So I went to the Gabelli Automotive Aftermarket Conference in Vegas, and I met Greg Hensley, who ran O'Reilly. I loved their model. They were 50% do-it-yourself, 50% within auto dealers where they took the product to them so they could fix cars, whereas AutoZone was all do-it-yourself and all retail. I liked what they did. The stock was $35. And for whatever reason, I never gained the conviction to buy it. And several years later, I think it hit almost 400. So there's a few of those. Are you trying to depress me? Because you succeeded.
Thank you, Paul, very much for your great presentation. So my question is, you have been a long-term holder of the stocks of Berkshire Hathaway, and you follow the company very closely. So can you think of some of the reasons why, even though everyone now knows how great Buffett is, but still the stock has consistently outperformed?
I think, and he's talked about it in the annual, and that is that a couple things. There's businesses that he owns that the full value is not really reflected on the books. I think Geico, I think Geico's on the books for $2 or $3 billion, and Geico's probably worth over 10 times that. Mm-hmm. And so I think people are realizing, one, there's a lot of businesses that Buffett owns that are private businesses that are worth a lot more than what's reflected in Berkshire. The second thing is, even though we're concerned with succession and there's nobody on the planet like him, because in the early 80s, the value of Berkshire was a lot of the public securities that he bought. Today, the majority of the value in Berkshire are private businesses that Berkshire owns, that even if he passes, those businesses should continue to flourish. So I think those two things are why the stock keeps going up. Plus, there's a huge safety component. Mm-hmm. You know, it's a safe stock. And finally, I would also say someday when he's gone, one of the things they're going to do is pay a dividend. If that stock ever pays a dividend, a lot of people who can't buy it now will, and that'll also help the price.
Okay, thank you very much.
Yep.
Hi, thank you again for coming here. And
you're welcome.
Hello?
Yep, I can hear you.
Okay, so you said that you don't have any limitations on the market cap of the company or whether it's a growth stock or not. But so I was curious, how do you actually screen stocks? Like when you look at the market, there's so many stocks out there. How do you begin the process?
What we've done is I read value line, mid cap, small cap, large cap. I've been doing it for a long time. So I've created a list of about 700 public companies, almost exclusively in developed markets, Western Europe, US, Mexico, Canada, Japan, Korea. And what varies, there's very few companies that you could raise. Now, I don't want to get carried away here. There's very few companies you could raise that I don't know about. What varies enormously is the breadth and depth of knowledge I have for some of them. So companies like Progressive, I spent 5 years of my life on Progressive, and Ruane made $2 billion on it. I really knew Progressive. I wish I knew, all 10,000 or 700 or whatever. Like I don't, but that's how I do it. I screen them, and I've created lists. I have 6 lists that I created. One is just great businesses. I don't even care about valuation. And then I go down the line, and it's all based on the quality of the business, based on returns on equity, leverage, and things I know. And so I have lists of all them, and they all have spreadsheets. And I keep my eye on all of them with my team. But that's a great question.
Thank you.
Yep.
Thank you again. In terms of your research process that you mentioned earlier, can you talk a little bit about maybe past the Valley Line point, your field research and sort of the individuals you contact for the companies you're looking at to get more information on?
Yeah, what we do, one of the things that I didn't talk a lot about, we really believe in field-based research. Looking at the numbers, you think about it, when you look at the numbers really raise questions. Why is their return on equity 25 and everyone else in the industry is 15? Why is their operating margin 30% and everyone else is 14? The numbers really give you questions. The problem is everyone can look at the numbers, and there's a lot of really smart people out there. So what we try and do is we try to know the industry size, understand an industry, the dynamics of the industry, the nature of the competition, and then we try to study all the companies, both public and private. We read annuals. We'll go back 20 years and read annuals and try and understand all the companies and all the market specifics. And then what we do, after we've done all the financial analysis and all the companies and the competitors and all the industry analysis, then we say to ourselves, what 1, 2, 3, 4 people, male or female, on the planet could give us really unique insights. So it might be a former CEO who retired 2 years ago and now he's living in Naples. It might be, one example is a gentleman who helped Nike build their distribution, their marketing business. He was one of their distributors, and Phil asked him to come in-house and go around and either ask the distributors that were distributing Nike product to give up their businesses and come in-house or fire them. And he did that. And I spent time talking phenomenal insights. So we try to find a few people that can really give us, and the reason is it makes the numbers come to life. It helps us understand why their operating margins are 30% and everyone else is at 10. Is it sales mix? Is it geographic? Is it product? I mean, what is it? What's unique? Is it their culture? Is it their locations? Like Sam Walton started building Walmarts in these small rural markets. He started in Bentonville. He would go into small rural markets and kill everybody. So he'd kill the Lountzis retailer, he'd kill the Thanasakos retailer, he'd kill them all. And then when he got bigger, he started going into the bigger markets. So there's a lot of ways to look at, we try to just look at non-traditional ways, and then we dovetail all the qualitative stuff on top of the numbers. So if the numbers aren't good, we won't even look at it. But if the numbers are good, we want to try and understand it. So we go out into the marketplace, we talk to competitors, customers, former employees, vendors, anybody, thought leaders, anybody that consultants, anything to get that insight.
Thank you.
Yep.
Hi, Paul. You mentioned that you look for management that is good at operating the company, who are good capital allocators, and that you look for management that's open and honest. With regard to the third point, I know there are investors that make it a point not to meet with management because they don't want that to bias their decision making. Can you speak to what kind of criteria you look for and what kind of process you follow to identify good management?
That's a great question. The numbers help a lot, but I never go visit management, ever, unless I've done the earlier stuff I talked about. So if I've talked to former employees, if I've talked to competitors, if I haven't talked to other people that have given me insights on the management and the company, I won't go visit management. And the reason is, you know what they're going to tell you. And it's all going to be good. So I like to talk to other people who can really give me insights. You know, somebody that might even work for somebody. Let me give you an example. We were doing work at Runway on a finance company. And he was working for a company on the West Coast, and he was hired to go work for a company in Chicago. So one of the things I did, I went to the company he was at, which you would know, and I found 2 people who worked with him. And he was a vice chairman there. They gave me incredible insights. And guess what? When he joined the company in Chicago, he did exactly what he did when he was in California. He made acquisitions, he cut costs, he took the cost savings and he invested them in marketing. It's exactly what he did at the new company in Chicago. So when I went and saw him, I had so much more insight on what he did and what he might do, and I could ask far more intelligent questions. As opposed to if I just read the annuals and just showed up and met him, I wouldn't have had that insight. Yep.
Hi, Paul.
Hi.
You mentioned that you have a very comprehensive and exhaustive research process, and you also do very comprehensive postmortems. So for the few omissions that you've had, was there a common trait with all those companies that caused you to not invest in them?
No, there wasn't a common trait. There's always something that keeps you from pulling the trigger. And sometimes, you just don't think through clearly enough. I found, at least in my experience, the companies that we really made a lot of money on, things became clear to me, and I could see it with clarity. O'Reilly was one I just had a hard time seeing it with clarity, and I really missed it. And I should have been better prepared because I knew the auto industry backwards and forwards could have progressed. And the average car in America is 12 years old, and 380 million of them, and I knew all that. And so it made sense that all the industry stuff, O'Reilly, and they had a unique business model, because 50% they would sell to car dealers and their mechanics there, and that's a different distribution model and a whole different business than having your own retail store where you and I go in and buy stuff, which I would never do because I can't fix anything anyway. But the point I'm making is when I do postmortems, I've mostly done them on mistakes of commission, but the mistakes of omission, there's been a variety of reasons that I didn't pull the trigger. And it's very frustrating. And Buffett's talked about that. Fannie Mae, Walmart, and several others.
Thank you.
Yep.
You talked a lot about the courage you need to make an investment decision, and on the flip side, the humility to look at that, or to kind of balance your investment process. I was wondering if you could talk a little bit about periods where you've made a mistake, and then the humility to understand your original investment thesis has changed, and how you go about that emotionally, and then as well as process-wise to move forward and either look at the fundamentals of the business have changed or reevaluate where you were originally coming from.
Even companies that have been successful, one of the things, here's an example on the upside. So I've talked about Mohawk or United Health and others that we've been very fortunate. One of the things that I learned to do, a really smart friend of mine once said this to me, what's really hard as an investor is you're always looking at the cost and the price you paid. So I'm making this up, but let's say you paid $15 per stock. And now it's 75. So you made 5-6 times your money. And the question becomes, why don't you sell it? And one of the things he said to me a long, long time ago, he said, every day you go in, it's buy, sell, or hold. And the point he was making is, can't look back, you have to look forward. And Mohawk's a great example. The company that we bought in 01, 02 initially is so different from the Mohawk today. They have tile now, they've made lots of acquisitions, they're more international, it's a totally different company. And so what I'm getting at is, one of the things that has really helped us, as it started escalating, and it went to 100, 110, 120, I remembered back in 08, 09 when it went back down, we kept thinking to ourselves, let's evaluate it from now. And when I did that, every time I listened to a conference call or reread the transcripts, I said, I'm not selling it. And so thank God we did that, because we didn't sell, we've sold about 35% of it, over 205, 210. And the old Paul, many years ago, I might have sold that at 100 or 110 or 120. But what I did is I removed the past, got rid of it, and every time I'd look at it, especially during quarterly earnings, I would say, what's different today? And they proved me wrong. Like, they paid $1.3 billion for Dow Tile many years ago, and I thought he overpaid. And Frank Boykin, the CFO, and Lorberbaum, the CEO, are really smart. Well, one, the margins were double or triple what Carpet was. And two, it was growing far more rapidly. So they were right. I was wrong. But the point is, on the upside, be very careful about what you paid and looking at the past, and focus on day one. What do you think it's worth from now on going forward? So that's one example. The postmortems on like Mattel or Harsco or others, even on ones of omission. United Healthcare, we did really well on United. To show you how dumb I am, when I was at Runway, we studied the whole HMO industry. Len Abramson in Philadelphia, US Healthcare, Steve Wiggins at Oxford, on and on and on. We interviewed everybody. And what was unique and different, and I was probably a little older than you guys then, Bill McGuire at United was really, really unique. He was a physician by training, and everyone else, Cigna, Aetna, US Healthcare, WellPoint, all these guys looked at healthcare from an actuarial mathematical standpoint. This medical procedure is this is how much we can price it at, this is how much we make. What McGuire did, it's all in my notes. What McGuire did is he looked at healthcare needs and he built businesses around them. And so today, if you guys ever look at United Healthcare, it's a $184 billion business. But the jewel in United is these 3 Optum businesses that McGuire created. One of them is Optum Insight or Ingenix. It's $7 billion, makes 20% margins. It's unbelievable. It's the best data analytics company in the world. I told them to spin it out. If they spun that out, that thing's worth $20 billion. The point is they have 3 Optum businesses that in a few years are going to be making more profit than the much larger healthcare business, employer and state and all the traditional HMO businesses. The point I'm making is if I had been smart and recognized that he was unique and different. For example, you guys are familiar with investor relations, right? So what did he do? He called John Penshorn at Piper Jaffray on the sell side covering healthcare. He calls up a sell side analyst and he says, John, we need an IR person. Many IR people are just mouthpieces. They just speak for management and tell them what the CEO tells them to say. He went out and tried to hire a sell side analyst. Why? So that John could give them strategic insights on their competitors. When they went to analyst meetings, when they went to industry conferences, he could see what others are doing and help Bill formulate strategy and competitive intelligence and so forth. That's a unique and differentiated way. That's an anomaly. That's not normal. And so it's all there, and I didn't see it. Had I bought, and I didn't have a business then, I was up in Wayne, had I bought United back in the early 90s, I'm making this up, guys. We would have made 100 or 200 or 300 or 400 times the money. I mean, there's a perfect example. Now, you still worry about it even today. The goal, long term, we're going to go to single payer. And that's what Obamacare really was. The problem with healthcare is it's about 3 issues. It's about access, cost, and quality. And Obamacare addressed a lot of the access. So a lot more people are getting insurance. It didn't do a whole lot on quality and cost. My point is, there's an example. So I reflect on those, and what's great about it is, in January, when I did my 65-page report, in January of 2013, because of that prior knowledge when I was a dodo, I felt that Optum was a gold mine, and they significantly exceeded what they did with Optum. And those 3 Optum businesses, they have the 3rd biggest PBM in the country. Those 3 Optum businesses are worth a fortune if they spun them out. The stock was at 52 with 1 billion shares. So the market cap was 52 billion. I felt the 3 Optum businesses were probably worth 30, 40 billion plus on their own. And so we bought a bunch of it at 52. It's 170 now. But I missed out on the real explosion, back in the early 90s.
Thank you.
Yep.
Hey, Paul. You mentioned earlier that you were very, very comfortable with the automotive business. We've learned in the past that there's a lot of value investors that sort of shy away from tech, the tech sector, for instance. So could you elaborate on some business models that you're really, really very deep into, and some business models that you sort of shy away from?
That's a great question. Well, we own Progressive Insurance. And one of my concerns with Progressive now is these, cars that don't need drivers. What's that gonna do to the insurance business? Virtually every company we own, there are technological implications that really concern us. Progressive's one of them. But then there's others like Martin Marietta. And Martin Marietta, it's crushed rock, their aggregates business. They also have cement and asphalt. But the crushed rock business is a great business. It's a local monopoly. If you have a quarry, you can only take the crushed stone 100, 150 miles from the quarry. So if you need crushed stone for a road, there's nowhere to go. So in that case, I don't worry about technology. And no one wants a quarry built in their backyard anyway. So that's a great one. But Progressive's one. United Healthcare, I've just been telling you how fortunate we've been and how great the Optum business is. United Healthcare, I worry all the time because of the government. The government could wake up someday and just say, we're going to go to a single payer system. And I always worry about that. Now, even if they did, they still need United. But what would that do to the company and to the stock? And so virtually every stock in my portfolio, we're trying to understand what the technology and what the implications are on every one of them. And in those where, like I gave you the example earlier about cable, our daughter would come home from a football game and she'd go watch her Dell laptop, Hulu, on her Dell laptop in 2007. So I went out and met the guy who ran Hulu just to get some insights from him. And because of that, I stayed away from cable. And I think the cable companies in America are in a lot of trouble. No one cares about the voice over IP phone. No one uses it in New York. They give it to you automatically. The broadband, the government's never going to let them charge whatever they want for it because it's a monopoly everywhere where there isn't FiOS. The cable companies have monopolies, and their video products are in a lot of trouble. People don't, they watch over the top. I mean, you guys are doing Netflix, and I know I'm paying for our daughter's Amazon video and I don't know, Hulu and all that stuff.
Thank you.
Yep.
Okay, we're getting close to the end. So, a couple of questions. So, value investors are very successful. They're nice people. They live long.
This is all great.
They live long. Why is not everybody a value investor?
Because I think it's a lot harder to really do it well than it seems. I think the qualities, it's what I said, it's a very, very lonely business. It's enormous responsibility. It's hard to execute and to do. And a lot of it is your emotional makeup. I mean, what I have found, a lot of the really good money managers are loners. Like, even though I like people, I'm not, like social stuff. I'd rather be home reading and thinking and learning and figuring stuff out. You have to be a little different that way. And I found a lot of the really good money managers, it was funny. Again, I have many, many flaws, and I don't know what my future holds. But my old football coach came to my office one day in Pennsylvania. His name was Dave Piscatelli, and he said to me, Paul, you played quarterback, you did well in school and all this, but you never, ever hung around with anyone. He said, even when you played football, you were always off. He's right. It's just my nature. It's just how I like it. I don't need lots of people to be around me to be stimulated. I can care less. And I think that's been really helpful as an investor. And I think that's a common trait. That's how Bill was. That's how Bob was. That's how Chuck is. And I certainly don't want to apply that to all, but I think the things I said about William Green, the willingness to be lonely, a lot of people don't want to be lonely. I can care less. It just, and like, I have a great team of people that I love working with. Tina's with me since almost the day we started. I love her to death. So I moved to New York. My whole back office is in Pennsylvania. I believe in loyalty and so forth. But, at the end of the day, when I was in Pennsylvania, I loved working with them. I tried to treat them really well, just like Bill Wayne treated me. But I would stay at the office oftentimes till 8 or 9 or 10 at night. As much as I loved my team, I loved when everybody left. And I could just sit in the office and think. Don't answer the phone, turn it off, just think. So that's, I just think it's hard to do. They're difficult qualities. And it's really, really difficult to go against the crowd. It's just not normal. People are jumping in and buying things, and you're selling. People are selling things because they're terrified, and you're buying. That's really hard. And, I get excited when the market gets killed. And even though this sounds kind of weird, when stocks are getting killed and your stomach's churning, that's when you really get excited. That's when you know you're going to make money. It just doesn't happen at all. And it's really, really hard to do. I mean, think about it. Client gives you $1 million, and 2 years after they give it to you, so they give it to you in 2007. Let's say you fully invested. And 2 years, we weren't. Let's say we weren't. 2 years after they give it to you, because the market got killed and the S&P peaked the trough, fall of '07 to spring of '09 was down 60%. So the $1 million I'm making is 400 grand. I mean, think about it. What do you tell the client? I mean, you just tell them, we're not budgeting. Our companies aren't going bankrupt. We believe in all of them. We've done the work. We're not selling anything. In fact, if you have more money, you should be sending it to them. But think about it. No, I mean, you can ask actuaries, and all the state data supports this. People, it's just normal. They buy when they feel good, and they sell when they feel bad. It's just, and to do the opposite is a lot harder to do than you think. It's really hard. You know, so I'm telling you, do you know what it was like when Mohawk got killed and lost 80% of its value? You want to throw up. I'm serious. This is people's money. But we knew the company, we knew the industry, we didn't budge. Not at all. We didn't budge, and we bought more. And that's really hard to do. So I just think, Professor, it's really hard. It's a personality, it's a way of thinking, and it's not the normal way that most people think.
Okay, and the last question. I guess I can infer from your speech what you're going to tell me, but can you summarize for us what is the most important thing in investing and in life you learned over the last 30 years?
Well, there's a few that I would, in investing, it's getting great clients. That's number one. Number two in investing is your temperament and your emotional makeup. I mean, if you don't, Buffett has even said this, temperament is more important than intellect once you have a certain intellect. So one, what I said, two, temperament is really, really important. So the right clients, and then the right temperament. And then three, you have to be a voracious consumer, eater of knowledge and learning. You have to be a learning machine. You want to be smarter. I try to read 3, 4, 5, 6, 7 hours every day, 7 days a week. Every day. I just love learning. And what's neat about what we do, I was blessed. I work for marvelous people. I've been so lucky. But I never was focused on one industry. Like so many people on the buy side or sell side, you know, you go to a big firm and they say, okay, Paul, you're going to be responsible for the auto companies. Well, after a year of studying Ford, GM, and Chrysler, I'd have like a nervous breakdown. I mean, what's there to know? I already know. I talked to the manager. So I was blessed because I could be a generalist. So when I wake up, I get to study REITs and broadcasting and pharmaceuticals and biotech and managed care and auto parts, where I screwed up with O'Reilly. It's really, really fun. And every day you get to learn new things. And then I built a network of a lot of great friends that are really smart. So it's a really fun business. But it's also a really hard business. And one other point, Bill Ruane, think about this. Bill Ruane and Rick Kniff were within Kidder Peabody. And Warren Buffett went to him, it's in his 69 letter. He recommended that some of his clients, smaller clients, give money to Bill so he could start Sequoia. And they started Sequoia July 15th of 70. I think they got $25 million from Buffett clients when he folded the Berkshire or the Buffett partnership. And just think about it. So they got $25 million from him, plus they had some separate accounts. Bill had a Harvard MBA, Rick had a Harvard MBA, Bob joined a year later, had a Harvard MBA. Carly joined several years later, she had a Harvard MBA. So all these relationships, Mr. Buffett's help, and then the market, if you'd have given them $10,000 in July 15th of 70 when they started Sequoia, 3.5 years later, December of 74, 3.5 years later, because the market got killed in 73 and 74, you would have had the same $10,000. You would have made no money. So you would have thought Bill was an idiot. And the point is, they almost closed the firm. Several people left. They thought it was going to go bankrupt. Bill had a couple kids to support. Rick had 5 kids to support. We're in la-la land right now. The market's up 8 straight years from counting 09 through 16. 15 was up slightly with dividends reinvested. Other was a little negative. But all 8 years are up. 6 of the 8 were double digits. Everyone's a genius. We're all brilliant now. What really matters is what happens when the market starts getting really hit. That's when we hope will shine and when you really step up to play. And it's hard. Now we've found these fixed adjustable preferreds. If we had like 06, 07, we'd be in cash. So a client calls you up and says, Paul, I pay you to invest and you have 30% in cash. I can do that. What they don't realize is that cash gives you optionality. And if you look out, like Bezos said, the longer your time horizon, and that's another thing. When I started the business at 40, one of the things that sustained me is I always thought about Runway almost folding. So $25 million in 69, I don't know what that number is today. Is it 300 million? Is it 500 million? I don't know what the number, but it's a big number. The point is they have a phenomenal record. Even with some challenges recently, they have one of the best, maybe the best long-term mutual fund track record in history. So the point I'm making is it's a really tough business. It's very, very hard to be better than everyone else. And it takes a unique set of skills and some luck to really be able to do that. It's really, really hard, Professor. It's hard. And the other thing that's really hard about it is succession. Very few firms really survive, beyond the founders. They just don't. And we worry about that with Buffett. Even though a lot of the companies will go on without him, very few, Henry Singleton, Janina, ITT, Charles Bluedorn, Great Western, none of those companies survived after the founder died. So, and when we started our business, rightly or wrongly, I didn't look at it over a 1 or 2 or 3 or 4 year period. I was 40, 41. And I said to myself, when I'm 80, I want this to be a really successful business. And that's my goal. I set myself up for a 40-year time horizon. And that's how I look at it even now. Now, I don't know if I'll live that long, but that's what I'm trying to do. And I think that really helps you when you lengthen the time frame of how you look at something. It puts less pressure on you. And the fact is, there's nothing, I can't do anything else anyway. So that's pretty much it.